In this video, we'll be discussing the prediction made by James Gorman, the CEO of Morgan Stanley, who has warned about a potential banking collapse in 2023. According to Gorman, the global economy faces a combination of factors such as rising inflation, high levels of government debt, and the risk of central banks tightening their monetary policies. He believes these factors could trigger a financial crisis impacting the banking sector worldwide. So stay tuned as we dive deeper into this prediction and explore its potential impact on the global economy. Signs of a recession have been present for months, especially since inflation has become a major concern, and the Federal Reserve has taken steps to reduce the amount of money flowing into the economy. However, some people deny the situation's reality and instead believe that the economy is strong and a new tech boom is imminent. The truth lies with the financial institutions with access to detailed information about the market and economic trends. Recently, Morgan Stanley has sounded the alarm bells and warned of what's to come. The author notes that during the 2008 global financial crisis, the Federal Reserve turned to Morgan Stanley for help before the bank was forced to borrow $107 billion, the largest amount borrowed by any bank in history. Warning signs are beginning to reappear, and Morgan Stanley's predictions of a next Great Recession are being taken seriously. Morgan Stanley is a global firm with a vast network of over 80,000 employees, offices in major cities worldwide, and control of over $1.1 trillion in assets under management. As a leading financial institution, they routinely provide information about the market and economic trends to their customers and investors. They recently released their 2023 investment outlook, which is worth paying attention to. They make a few main points. The first is that after 2022 is over, equity investors will likely feel that it wasn't as bad as it seemed. This is understandable since at the start of 2022, and there were numerous headlines claiming that it was the worst start to a year for markets in 50 years, and that it was the worst year to invest in stocks since the global financial crisis. Although these facts were true and assets performed poorly throughout the year, there were some moments of improvement, such as bear traps and mini bull runs, where stocks rose for several weeks at a time. By the end of December, the S&P 500 was only down by about 20%, or 30% when accounting for inflation, which was much better than what many people expected given the various global crises occurring at the same time, such as the war in Europe, the energy crisis caused by rising gas prices, and China's lockdowns due to COVID-19. As a result, early 2023 equity investors are cautiously optimistic, believing that the Fed has curbed the threat of inflation and that the markets have avoided a Black Monday-esque event and a recession. However, Morgan Stanley warns investors to stay calm and expect everything to turn out perfectly fine. They are particularly concerned about yield curves and their current inversion, which refers to how bond yields are usually higher for longer-term bonds to account for inflation over time. Still, during a recession, bond yields flip around as central banks try to stimulate the economy by slashing interest rates. Currently, the markets are pricing in a recession as the yield on a 10-year Treasury is lower than that on a 2-year Treasury. This is a reliable indicator that a recession is coming, but it is not good at predicting when. In 2006, there were 22 months between the inversion and the eventual recession, while in 1980, there were only 10 months. Morgan Stanley believes that a recession is coming, but it may be delayed by a few extra months. According to a report by Morgan Stanley, the looming collapse in earnings is expected to happen in 2023, but not immediately, which could also make the crash worse when it finally comes. The report also states that the savings rate of Americans today is lower than it was at the worst point of the global financial crisis, which could cause spending to halt in some point in 2023, leading to a crash. Morgan Stanley is also concerned about antitrust actions from the U.S. government towards tech giants like Google and Apple. They suggest diversifying portfolios or hedging against inflation by investing in gold, as it is one of the few assets that hasn't been hammered over the last year. Morgan Stanley's chief U.S. equity strategist Mike Wilson warns that corporate profit estimates are still too high, and stocks have never been so risky and presented such a poor potential return in the last 15 years. Wilson predicts a 22% decline of the S&P 500 over the next few months as a possibility, with the chaos likely to start in the first quarter of 2023. Morgan Stanley has been ahead of the pack throughout this bear market and in the run-up to it, being honest with their customers about their outlook for 2023. Morgan Stanley has been preparing for a potential recession since last year and took aggressive measures by firing 1,600 staff in December to ensure the company's solvency. While predicting a recession may be easier than some think, timing it is much more difficult. That's why buying into markets at a better price point is important to minimize risks and maximize benefits. While Gorman's prediction may be alarming, it's important to remember that predicting the future of the markets is never a sure thing. However, it's always wise to be prepared for any possible outcome. And that's it for today, guys. If you enjoyed this video, do well to subscribe to this channel and give this video a like. Thanks for watching. See you in the next video.